All right. Good afternoon, everyone. Welcome to the Warriors of Wealth Masterclass on multifamily financial analysis. I am Stacy Conkey, and I'm going to be your instructor for today. Thank you for spending this time with us. I am very excited to give you guys a ton of content, a ton of information, and really teach you how to start thinking through deals that you're going to be looking at. So, one of the things that's super challenging as a real estate investor is overthinking and spending too much time and getting stuck in analysis paralysis and not knowing when you should make a move and make an offer, or whether it's even worth it to spend time diving into the details on a deal. So what I'm going to teach you today is, first we're going to lay a really solid foundation. So pen, paper, get ready for taking notes. We're going to lay a very solid foundation of knowledge to teach you how to think through all of the various pieces of doing a multifamily financial analysis. And then I'm going to actually show you how to use a tool that we'll make available to you at the end of the masterclass for free. It's our gift to you. That will allow you to quickly put in a couple of different figures and see, okay, at a high level, does this deal make sense, and do I want to look further into it? All right, so just a little bit about your instructor so that you know who it is that's teaching you. For those of you who don't know us yet, we are Jen and Stacy Conkey. We are founders of Warriors of Wealth, and we live in San Diego. We've been investing in real estate since 2003. So we've been doing this for 17 years now. We've invested in 14 different markets across the United States, and all of our investing has been done remotely. We don't go to our properties. We don't fly across country to close deals or to watch inspectors. Everything we do from San Diego. So just a little bit of background. So Jen was a leader in corporate America for 22 years. So she did investing as a side business throughout her career, and then she was able to retire and focus solely on real estate. Stacy, who is me, I was a CFO in corporate America, and I left to invest in real estate. And I really have a passion for coaching and teaching. So I've been coaching new investors for more than 10 years. And as you'll see as we go through, I just love doing it. We just have a passion for helping people get to the next level. So Jen and I combined our skills to create Warriors of Wealth real estate investing, coaching, and mastermind. So we're bringing this class to you as a free class, just our gift to you, so that you have a broader foundation, so that as you start stepping toward your goals in real estate, you can do it safely without getting stuck in analysis paralysis, and really know what you're doing as you're moving forward. All right, so let's jump on in. All right, so for starters, we're going to start laying some foundation of knowledge, because when I get to the point where I'm showing you how to use the calculator, it's not going to make a whole lot of sense what you're looking at if you don't know the basics. So let's start there. All right, so the very basic is, let's start with net operating income. In multifamily real estate, net operating income is one of the main pieces of information that's used for a variety of factors, for analyzing a deal, its performance, looking at debt service coverage ratio, which is something lenders look at, for calculating capitalization rate, which is used in apartment complexes, 5+ units, to establish value. So there's a number of different things that net operating income is used for. So we also call it NOI. So you're ever in a networking thing or talking to someone and they say NOI, this is what they're talking about. And net operating income is a function of all of the income from a building, which would typically be rents, but it could be things like, if you charge for storage, or if you charge for parking, or if you have vending or on-site laundry, anything like that that is income coming into the property is considered revenue. Expenses of the property are things like property taxes, insurance, maintenance, property management, marketing, leasing fees, things like that, like any cost that you're going to have to spend to operate the property. The one expense that it does not include, and every once in a while I see somebody include it, it's incorrect. You'll see it sometimes too when brokers put out financial statements, and they just, I guess, never learned how to calculate net operating income correctly. You'll sometimes see that there's a mortgage payment included in net operating income, but that's incorrect. Net operating income is not taking into account financing, because an NOI is really going to be based on the performance of the specific property or the building. and how someone finances it will impact the cash flow, but it doesn't impact how the building itself operates. So if one person pays all cash for the property, well, they're going to have more cash flow than the next guy. But if someone else finances it, they're going to have less. But the net operating income would be the same for both operators, regardless of how they finance it. Okay, so revenue minus expenses is your net operating income. That's the first foundation. The next foundation we're going to talk about is your purchase price minus your down payment is going to be your loan balance. And that probably seems really obvious, but I'm going to lay this in a layered impact so you can kind of see how all of the numbers flow through the deal. So let's say, for example, that you're getting a property for, I'm just going to make it easy, for $100,000, and you're putting down 25%. That would be 25,000. So your loan balance is going to be your $100,000 purchase price minus your $25,000 down payment. Your loan balance would be $75,000. Okay, we can do the same thing if we're talking about apartments and say purchase price is $1 million minus $250,000 down payment. Loan balance will be $750,000. Okay, so loan balance is going to be a function of a couple of different things. All right, so loan balance is going to be a function of the amortization period and the interest rate. All right, and the payments that you make on your loan every month and annually is called debt service. So if you're kind of comparing it to what you pay for your single family home or your personal residence that you live in, you just call it your mortgage payment. So I'm going to teach you as we go how to speak, how to think like a professional investor. All right, so your loan balance is going to be a function of amortization period. Amortization period is the time frame over which your payments are split up. So what you're probably most familiar with is a 30-year amortization. So in a regular single family home that you live in, that's your personal residence, it's typically going to be 30 years. So what that means is every month you're making the same payment for 30 years if you don't refinance. And over the course of the 30 years, eventually you have zero balance. But what it does is it separates the interest and the principal over the course of time, so it ends up being the same payment. Well, every month that you make that payment, you're starting to pay a little bit more towards principal. So at the very beginning of the loan, your payment is mostly interest and a little bit of principal. And as you get towards the end of the loan, it's mostly principal and a little bit of interest. Your amortization period is going to impact what your payment would be, because let's say they're going to give us 30 years to pay off the loan versus 20 years. If I have to pay off the same amount of money in 20 years, I'm going to have to make higher payments in order to do that. So that's why the amortization period does impact your debt service or your mortgage payment. The other thing that's going to impact your debt service is your interest rate. So if I have an interest rate of 6.5% versus 5%, my debt service is going to be higher because I'm paying higher interest on the loan balance. All right, so that's our first group of foundations. Okay, so next we're going to talk about cash flow. So cash flow is going to be a function of your net operating income, which remember is your revenue minus expenses, minus your debt service or minus the mortgage payment, and that's going to be your cash flow. Cash flow is your net profit. It's the spendable cash you have at the end of the month, at the end of the year. So your property is going to produce X amount of dollars. That will go in your pocket, or you could just put it in the bank to save, for upgrading the property over time. But either way, that is what's left after everything has been paid. All right, next we're going to talk about your all-in costs. So when you're doing a deal, when you're new especially, sometimes you don't realize what all the different pieces are. So I want you to think through that. So your all-in costs, when you're evaluating how much money you're going to have to come up with, is going to be a function of your down payment, which we just covered, but also your closing costs. So closing costs are costs you're going to have to pay to the title company when you close, plus your lender costs. There's typically some amount of points or fees when you're closing, so you're going to have those costs, and also any impounds. Now, impounds are what a lender will charge you. It's not a charge. It's like a deposit. That's the best way to put it. So it's going to be your property taxes and your insurance. And let's say they take a total of, let's say your property taxes are $1,200 a year, and they want you to have 3 months of impounds just held in escrow. So they would take that $1,200 annual property tax and say, okay, well, that's $100 a month. We want you to have 3 months of that put aside. and they're going to hold it. So that would be $300. So property taxes and also insurance are what most lenders are going to make you put aside in the form of impounds. So when you're calculating how much money you're going to need for a deal, you want to remember those impounds, because that is money. It's not a cost to you because that's still your money. They're holding it, but it is money you have to come up with and come out of pocket in order to close a deal. And we had someone in our mastermind a couple of months ago, Bobby, who he closed on his first deal ended up being 12 units, but originally it was 16 units. He was closing on a portfolio package, and it was 6 duplexes and 1 quad, which is a 4plex. And as he was getting, through the due diligence and going through the lender and talking, what he hadn't calculated in was the impounds. And so because he was going to have to come up with all this extra money, and on top of it was during COVID, so all the lenders were more freaky about everything, so they were requiring bigger deposits, he decided to drop the quad and just focus on the 6 duplexes because of the amount of money that he was having to come up with in the form of impounds. And he just didn't want to be stretched that thin. So he decided to just do a smaller deal, get his first 12 units, and focus on those. So that's why you want to be thinking about impounds as you're going in, because it is going to be cash out of pocket. So when you're evaluating a deal and trying to figure out, is this a good deal for me? Is this, is my money working for me? You're going to do something called a cash on cash return analysis. We might also call that return on investment. So the way that we do that is you take your annual cash flow, right? So you have all the revenue coming in throughout the course of the year, minus all the expenses going out over the course of the year, minus your debt service for the year, and that's your annual cash flow. So everything we do in multifamily is based on an annual basis. So I might look at something on a month-by-month basis, but when I'm doing any kind of calculations, and this is for you to know too, as you're talking with professionals in the space, talking to your realtors and brokers, you always want to be speaking in terms of annualized. So we take our annual cash flow and we divide it by our all-in costs. Okay, so you're adding the down payment, the closing costs, the lender costs, and the impounds. And you're like, okay, this is all the money that I'm going to have to take out of my bank account and put into the deal. So how much of a return am I making? So for example, let's say that your annual cash flow was $10,000. All right, so let's say $10,000 of annual cash flow. Oh, that's actually pretty low, but that's okay. We'll say $10,000 of annual cash flow. And let's say we had to put between our down payment, closing costs, lender costs, and impounds, we had to put up $100,000. All right, so we would take our $10,000 annual cash flow divided by our $100,000 all-in cost, and that would be 10%. So what we look at is, okay, that provided a 10% cash on cash return. Right? That's how you do the calculation. And so there's no right or wrong as far as what's high enough or what's too low for cash on cash return. Every investor is different as far as what are they looking for. So part of the reason that Jen and I don't invest in San Diego and why we invest remotely in other markets is that the cash on cash return here is exceptionally low because the rents aren't that high compared to the prices. So our all-in costs, let's say we're going to make $10,000 of cash flow over the course of a year, but it's going to cost us $1 million out of pocket to make that happen. Well, now our cash on cash return is only 1%. And realistically in this market, we'd probably be able to get maybe 3 or 4%, but it's very, very low. And not that there's anything wrong with that. If someone doesn't care about having a high return on investment, maybe they just want to own property in San Diego, then that's their option. We are cash flow investors, and so we are very concerned with what kind of return are we getting, which is why we tend to invest mostly in the Midwest, where the prices are lower and the rents are higher, so that we're maximizing our cash flow and we're minimizing the amount of money we have to put into our deals, and that gives us a higher return on investment. The other thing that you can always do to really spike up your cash on cash return or ROI is doing the BRRRR strategy. So the BRRRR strategy, or the other, for 5+ units, we call that a value play. So if you're talking 1 to 4 units, we do the BRRRR strategy, which is buy, renovate, rent, and refinance. If you're doing 5+ units, that's a value play. We buy, and it might be renovate, or it might be management turnaround, or basically improving the performance of the building, getting everything rented and performing, and then same thing, refinancing. So when you do the BRRRR strategy, the reason it spikes your ROI to such insane numbers is because when you refinance, depending on how good of a deal that you did and how well you did when you bought it, you can typically pull out a good amount of your money. So you might start with putting in $100,000 into a deal. And I realize that that's a lot for a deal for people just getting started out, but the numbers are even. It makes it easier. But let's say that we're putting in, $100,000 into the deal, but when we go to refinance, we're able to pull back and cash out 80,000 of that and put a new loan in place. So we basically we only have $20,000 in that property instead of 100,000. So now if we have $10,000 of annual cash flow, but we have $20,000 left in the property because we pulled our other 80 out to go do another deal, now we have $10,000 for a 20,000 investment. That's a 50% return on investment. And nearly all of the projects that we do are 70 to 100% cash on cash return. And it's just because we do a lot of BRRRR strategy value add projects where we go in and we improve the property, and we get the equity because of it. We'll pull some of that equity out and go use it to do another deal, another deal, another deal. And that's how you basically build a portfolio. All right, so that's why you want to understand how these work, because it's also going to help you to decide for you what is going to be a better strategy. Are you the type of investor who wants to just take a chunk of money, go put it down on a performing property and have cash flow right away? Cool. You're not going to probably get the best deal in the world, but if it cash flows, great. Or maybe you're the type of investor who's like, you know what, I like having some cash flow, but I really want to build equity also. Then you're probably going to lean more towards a BRRRR strategy or a value play, because that allows you to go in, increase the value of the property through your value add activities and or doing renovations, and then refinance and pull your cash back out and go do it again and do it again. But it's more work, right? It's more work, but your cash on cash return is much higher. So there's always a give and take, and both of those strategies are great. It just depends on you and what you're looking for and what meets your needs. Next thing I want to teach you about is cap rate. Cap rate can be pretty confusing when you're new, so I'm going to try to break this down as simply as possible. For starters, cap rate stands for capitalization rate, right? And cap rate is a percentage. It's always given in terms of percentage. The higher the cap rate is, the higher the property tends to cash flow. The lower the cap rate is, the lower the property tends to cash flow. So, but what's interesting about it is a very high cap rate market isn't necessarily considered to be a good deal. It's like if you're in, let's say like a D area, which is like considered a bad area, you might have a 13 or 14% cap rate, like on the books. Like technically the property could produce this much cash flow, but you're also dealing with a lot of management issues. So it's almost like for dealing with that management issue, you have to be willing to, you have to receive a higher amount of cash flow. And so they tend to have a higher cap rate. So high cap rate markets tend to be lower value markets, which seems a little counterintuitive, but that's the reality. All right, so I want to teach you how to do for now, sometimes that seed has to get planted and just sit there for a little bit as you're learning other things, and then eventually it comes together. So what I want to teach you right now how to do is how to actually calculate what a purchase cap rate is when you're looking at a deal. Okay, so if you're looking at any particular deal and you're looking at the net operating income that the seller is advertising, so this would be a deal that's already performing, right? So if they're saying, okay, we have this much operating income, and again, let's use the easy numbers. Let's say $10,000 a year is the net operating income, and they're asking $100,000 for the property. We would take that 10,000 divided by their asking price or the purchase price, and that would be 10%. So that means that that property has a purchase cap rate of 10%. Now, of course, you always have the option of going in and saying, well, I'm not going to offer 100,000, I'll offer 90,000. So if you were like, I wonder what kind of cap rate that would be, you would take your $10,000 net operating income and divide it by your $90,000 purchase price to figure out what your cap rate would be. And I didn't calculate it, but it's probably like 11 something percent, right? So you'll have a higher, the lower you pay, but if the net operating income stays the same, the less you pay, the higher the cap rate will be. All right, and vice versa. The more you pay for the property with the net operating income staying put, the lower your cap rate is going to be. All right, so let's talk about that from a property value standpoint. From a property value standpoint, if you take your net operating income and you divide it by the market cap rate, that will give you an idea what the property value is. So let me explain what I mean by that. Every market has, that's not necessarily like a full market, but sometimes it's neighborhood by neighborhood, but let's say by market, a city has a market cap rate. So that's what capitalization rate things are selling for or trading for. So if the market cap rate is 10% in whatever market you happen to be looking at, that'd be considered kind of high right now. With interest rates being lower, cap rates tend to go lower because the value of properties goes up during a time when interest rates go down, right? So whatever the market cap rate is, you're taking the NOI and dividing it by that to see, okay, well, how much should I pay for this property? So let's say someone's asking $120,000 for a property. And you know from talking to your real estate agent or brokers that generally speaking, things are going for 10% cap rate. And you're looking at the net operating income and you're seeing it's $10,000. You look at that and go, you know what? They're asking for too much money for this property. This property is only worth $100,000. That's why it's helpful to understand how cap rate works in any given market, because it will help you identify if you're paying too much for a property. Of course, the other thing you're looking at besides just the property value and the cap rate is also the cash flow and your cash on cash return to make sure that it makes sense. But these are the foundations that you're looking at when you're going to start actually calculating some numbers. All right, so what I'm going to do in a second is I'm going to stop sharing my screen. I'm going to reshare, and I'm going to show you how to use the Warriors of Wealth quick analysis calculator that I created for you guys so that you can very quickly identify whether a property is worth your time in looking at. Now, keep in mind, this is like a basic calculator. I'm not bringing everything into account, like impounds and closing costs and financing costs. It's just quick so that you know, okay, this is worth digging into. Okay, so this is our multifamily real estate investing Facebook group quick deal analysis calculator. So this is hosted on Google Sheets. So at the end of this, I'll give you guys a code. You can text in the code. I already have it set up with the link to send it to you, and then you can take this and run with it. When you get it, the first thing I'm going to show you is that when you get it, you need to first, like, if you try to edit it, it's going to say, oh, you need to have permission. So don't worry about asking me for access or permission, because then everybody would be changing the same document. It would drive you all crazy. So what you're going to do is go up to File and make a copy. And then that will allow you to make a copy in your own Google Drive. And I also put a note right here for that. If you're not yet in our Facebook group, I know many of you are, but if you're not in our Facebook group, there's a link right here where you can come join our Facebook group. Our Facebook group is where we do a ton of content just like this throughout the month. So it's a great place to just come and learn and be part of a really cool community of other people who are interested in, making passive income through real estate. Okay, so let me just show you how this works. So for starters, this software is going to give you a fast, efficient snapshot of your prospective multi-unit acquisition. As always, complete and proper due diligence must be conducted before closing. This software will help you quickly assess whether a property is worth pursuing further. You're going to enter the amounts in blue. All right, so the way that this works is I have these amounts in blue here, and these are all fields that you can adjust and change in order to see, like, what do the numbers look like down here. All right, I think, let me make this a little bit smaller. We have more page. Okay, so you have your purchase price here. So let's change this to $400,000. All right, and let's say that we're putting down a down payment of 30%. And I'm just using arbitrary numbers to kind of show you guys how things move throughout the calculator. Let's say our interest rate is 4.75%. Amortization period, let's say it's 25 years. If you're looking at 2 to 4 units, 30 years is really common. If you're looking at 5+ units, 25 years is a little bit more common. Number of units, let's say that we're looking at a 4-unit building, and let's say the average monthly rents are $1,000 a month. Okay, so these are your primary inputs. All right, so I don't have a place for you to put in like individual rents. So this is, again, it's for quick analysis. So let's say you're looking at a 4-unit and you have 1 unit at $1,200, one unit at 800 and two at 1,000, you're just going to add all four of them up, divide it by 4, and put in the average here, and that's going to give you an idea. All right, so the first thing it shows here is this is your down payment amount. And this down payment amount is based on the purchase price and the amount of down payment that you said here you were going to be required to make by the bank. Okay, so this shows you your loan amount. So the first thing we have here is your net operating income. So what I have built into the calculator, and the formulas are all available in there. So if you're kind of an Excel person, you can come in and make whatever adjustments you want to the formulas. That's up to you. But the income assumes a 10% vacancy / collection. All right, so the 43,200 is taking the $1,000 a month times 4 units times 12, so it's really $48,000 minus 10% for vacancy and collection. Okay, so it's basically 90% income. And then the expenses, because I'm not going to have a place where you have to go search for all expenses, I'm just flat putting 40% expenses in there. If you know you're looking at a building that has higher expenses than that, then you can go in and change the formula. Or if it has lower expenses than that, you can go ahead and change the formula up there and it will calculate it for you. Okay, then it shows your net operating income. And then over here to the right, because the presentation that I just gave you isn't going to come with this, just the calculator. So I wanted to make sure you had what you needed. So we have here net operating income equals income minus expenses, just to remind you guys how things are calculated. Okay, so in this case, we have net operating income, 25,000 and change. All right, then we have annual cash flow. So we have our net operating income of 25,920 less our mortgage payments or debt service of 19,000 for annual cash flow of 6,700. Then we get down to cash on cash return on the down payment. So in this case, if our annual cash flow was 6,700, but we had to put up $120,000 to make that, our cash on cash return is only 5.64%. So I'm not super excited about that. All right, what else do we have? Cap rate. Let's say our net operating income is 25,000. Our purchase price is 400,000. That means our cap rate is about 6.5%. And then debt service coverage ratio. So our debt service coverage ratio, we actually haven't talked about that yet. And let me explain where this is going to come into play and where it's important. When you're looking at a deal and you're looking at the end game, whether you're buying it, performing, or doing the BRRRR strategy, the thing you need to keep in mind is that your lender is always looking at how is the building going to perform and how likely is it that you're going to be able to make the payments for the entire loan period. Because banks do not like to take risks, right? But they have to because that's the business that they're in. So one of the things they look at in order to mitigate risk or to lower risk is having a debt service coverage ratio of typically at least 1.25 to 1.3. So what does that mean exactly? So the debt service coverage ratio takes the net operating income, so all the revenues minus all the expenses, and it compares it to how much the annual mortgage payments are. All right, so in this case, if we have net operating income of 26,000 or so, and we have annual debt service of 19,000, that is 1.35. What that means is we can for sure cover all the debt service, but we have above and beyond that 35% in cash flow. The bank is not really concerned about whether you're making money and you're cash flowing. That's obviously your concern. That's what we want. The bank wants to make sure that you can cover the mortgage payments and that you're making enough extra that should something come up unexpected, that you're able to still cover the mortgage. So this number right here is really important from the financing standpoint. That's when you really want to be paying close attention to it. The higher it is, the better. And Jennifer and I tend to run our portfolio at least 1.6 and sometimes higher than that. It just depends on how much cash we pull out when we refinance, but we like to leave it, even after refinancing and pulling cash out, we like to leave it at least 1.6 to, as high as like 2.0. All right, we like to have a lot of cash flow in our deals. All right, so those are just some of the basics. So let's go up now and let's just play with the calculator so that you can see how different changes impact, the numbers. So let's say that let's change the purchase price to, let's say you're like, well, I'm not that excited about those numbers. Let me see what this deal would look like if I offered only $350,000. And let's say that's the only thing we change. Let's say I'm going to offer $350,000. I leave everything else the same. Okay, our net operating income doesn't change because the amount of purchase price The debt service doesn't impact the NOI, all right? But our cash flow increased from 6,700 up to 9,000 because our mortgage payments went down. Our mortgage payments went down because our loan amount went down. And our loan amount went down because our purchase price went down. Okay, so does that make sense? So when you have a lower purchase price, if they accept it, your cash flow is going to go up if nothing else changed. Okay, your cash on cash return now went from 5 point something% to almost 9% because our cash flow was higher and our down payment was lower. So both of those things combined to increase our cash on cash return. Our cap rate went up to 7.4 because our purchase price went down. The net operating income stayed the same. Purchase price went down by 50,000, so our cap rate went up. And then our debt service coverage ratio also went up because net operating income stayed the same, but our debt service went down because the purchase price went down, so the loan amount went down, which means we're able to cover the debt service plus even more with our net operating income being the same. Okay, so that's how changing the purchase price that will change it. Now let's look at down payment. So what if we were doing a 20% down payment? Let's see how that impacts things. So we're changing our down payment to 20%, which means we lowered our down payment, but that also then increased our loan amount. So let's look at how that looks. All right, so our cash flow went down again. Well, our cash flow went down because we are paying a mortgage payment on a higher loan amount. But our cash on cash return is now almost 10% because although our cash flow went down, our down payment also went down because we went from 30% down to 20%. All right, and then the cap rate still the same because it's the net operating income and the purchase price impacting it, which doesn't have anything to do with the loan amount, so that would stay the same. Our debt service coverage ratio, oddly enough, actually stayed the same. The difference between the net operating income, the annual debt service, put it back down to 1.35, which was our original debt service coverage ratio when we had a $400,000 purchase price with a 30% down payment. So you can kind of play with these different numbers on any deals that you're looking at and see, well, how does that impact it? Let's change the amortization period. Let's say we're looking at a 30-year loan instead. All right, so again, NOI stays the same because the loan amount to purchase price doesn't change that. Our cash flow went up to 83.93. What was it? It was 67.64, and now it's 83.93. Well, why did our annual cash flow go up? It's because we are taking longer to pay off the debt, which means our annual or monthly mortgage payment and our annual debt service is now lower, which means we have more cash flow. That's the reason you would look for a longer amortization period. I mean, sure, it's nice to pay off a property sooner if that's what your main goal is, but if your main goal is to maximize your cash flow, you would choose, if the option was available, you would choose to go the longer amortization period so that you can get a higher cash flow. Your cash on cash return, now we're talking. Now it's at 12%. So you have your annual cash flow at 8,300, your down payment is only 20%, and the whole mortgage is spread over 30 years. So now to get $8,300 a year, but only put $70,000 to get it, now your cash flow is your cash on cash return, almost at 12%. So as you can see, as you play with these things, you're going to see how everything is impacted. Your debt service coverage ratio went up also because your debt service went down because you're taking a longer time to pay it off, so your payments are lower. All right, so all this can be a little bit confusing. The best thing that you can do for yourself is just get back in here and play with the numbers, take actual real deals that you're seeing advertised, put the numbers in, and just start to get familiar with how does making one change impact the numbers, because you're not going to pick this up overnight. It takes some time to learn this stuff, but this is the best way to do it so that the repetition of it will help it to start sinking in. And then when you're ready to start writing offers, you'll at least have a better idea of whether one deal versus another is worth spending time to go dig into those details. All right, I hope that was helpful for you guys. And like I said, I will give you information so that you can get a copy of this calculator so you can start playing with it yourself. If you'd like to get a copy of it, you're going to text the word tool. You don't have to put the quotes on there, just tool, to our business cell phone, which is 619-373-8461. And I have it set up already. It's going to send you a link to Google Sheets with this tool, and you just go in, do File, and save a copy. And then you can use this for your own business. All right, so text the word tool to 619-373-8461 to get a copy of the tool. And I know that some of you, there's some of you who come to these classes because you know that you're interested in real estate, and maybe you're just getting started, or maybe you've tried doing it on your own and you just couldn't really get anywhere. Or maybe you just want someone to hold your hand because it's a game. Real estate's a game, but it's a real game with real dollars. And sometimes you just want someone who's experienced to do it alongside you, so that you feel confident and you feel like you have a veteran looking at your deals with you. So if that's you, and if you want to get involved in the Warriors of Wealth Mastermind and just have someone to help you and have a community that you're working with as you're doing your deals and as you're getting started or scaling your business, we can talk about what it would look like for you to get into our mastermind. So over the next few days, we've set aside some time to talk with you and just see if we can help you. So we'll usually spend about 30 minutes or so, and we'll map out an exact action plan for you so that you can either get started if you're brand new, or if you've been investing and you're looking to scale your real estate business, or if you've been operating a business at home where you're investing in your home market, but you want to expand to other markets and work remotely. Like, that's literally our specialty. That's one of the things that sets us apart. That's what we specialize in, helping people build entire portfolios remotely. So you could be wherever you want. You can literally physically be wherever you want in the world, as long as you have an internet connection and a cell phone. Like, you can operate your business. All right, and if that's something that you'd like to do, you can schedule a free strategy call with our team. You just schedule or text the word freedom to the same number, 619-373-8461. And I have it set up to send you a link so that you'll go to the page. You can book your calendar, book a call, and then you can chat with us and we can talk about what strategy is going to make the best sense for you, tell you a little bit more about the mastermind, and we can assess whether you'd be a good fit for the mastermind, whether it'd be a good fit for you, and if so, we'll describe what that's going to look like.